Hello everyone and welcome to the Q3 edition of our Environmental Insurance Power Panel as we gather some of the biggest names across the Canadian insurance sector to discuss everything from PFAS to non-owned disposal sites to CPL. In this edition, we welcome Shauna Larvey, Senior Vice President, National Practice Leader Environmental at Gallagher, Shane McCarthy, Vice President of Complex Risk at Hub International, Aaron Weinstock, National Practice Leader Environmental at BFL Canada, and Justin Perry, Senior Vice President, National Practice Leader Environmental at Aon. So welcome everyone, and I started with the dreaded term PFAS. So how has the growing scrutiny around PFAS in Canadian provinces impacted policy exclusions, sublimits or underwriting requirements for pollution liability in recent months? Justin, I'll start with you.
Yeah, thank you, Paul. Yes, we've seen overall increased scrutiny, but no real change in the coverage. I would say all environmental constituents are based on how you've used them, what you know the presence is, etc., for coverage to apply. So in this case, other than very specific use cases, such as municipal landfills, for example, we don't see a lot of pushback or a lot of limitations or retraction in coverage with regards to PFAS on environmental policy specifically.
Okay, so Shane, then, is this a case of clients really having to understand what they're using?
Yeah, I think, well, even underwriters, the clients that are using the product, even the underwriters, as long as the clients can demonstrate a proactive measures to identify, manage, mitigate kind of the PFAS risks and the exposures, the coverage will still be available. Absolutely.
And then Sean, from your perspective, are we just sort of looking at this PFAS on a case-by-case basis here?
Yeah, for sure, Paul. Like Justin kind of alluded to it already, but it is very industry specific. Shane demonstrated obviously that it also is the proactiveness of the policyholder in terms of how they're managing that risk. I think the challenging part is obviously if you've got a situation where PFAS has been running through the site or has been being used on the site for a number of years, and how you delineate between those historical issues versus the new issues. And so, that might create some complications, but, generally as a whole, PFAS coverage is still very available. It's just, case by case based on, the site activities and the history of the site.
Just to wrap up this particular subject, Aaron, how do we make sure the clients are properly prepared here?
Yeah, so as the group has said, there's certainly more open-mindedness towards PFAS than there might have been a couple of years ago. Insurers will work with you to provide the coverage where they can, but certainly as brokers, it's up to us to explain what the implications of an exclusion would be, and then also to help coach our clients through collecting the right information, answering the right questions, and how to position themselves best to have the coverage if it was once or is being proposed to be excluded at some point. So getting the right information, that is critical to get the coverage.
Yeah, I'd love to zoom in a little bit more on the demand that we're seeing around environmental liability coverage, particularly from industrial and commercial real estate clients for reasons such as heightened environmental site assessments or regulatory cleanup orders. Shane, what are you seeing?
Yeah, I think there's been a constant increase in demand as far as for environmental liability coverage on the real estate kind of commercial real estate side, whether that comes from new ESA reports discovering, new contaminants and then that happening on the time of transfer and then having to have an education piece of how those risks can be transferred to an insurance policy, or just the heightened awareness around environmental concerns and regulatory restrictions or regulatory fines and penalties being in place and them wanting to take that risk out of the side of their portfolio. There's certainly the commercial real estate market is, primed with a lot of education around risk transfer and specifically getting into the environmental space. And it may not have been one that initially was, or for a long time has been top of mind as a risk transfer tool.
So there is increased demand there, Sean. It's particularly on the real estate side, according to Shane. Is that something that you agree with?
Yeah, I definitely agree with that, Paul. We obviously have seen an uptick from our commercial and industrial clients. The biggest thing here obviously is the education piece, which Shane already talked about, where, depending on the maturity of your client or the how long they've been in operation, and who's kind of taking the responsibility of managing the insurance. We often come across some of the smaller to mid-sized real estate companies that maybe don't have a dedicated risk manager or don't have a dedicated environmental health and safety manager. So they need education in that space, when they need to understand what the claim scenarios are. That ultimately, leads them to understanding that they need this coverage. So you did get some growth that way just from the education piece, but again, I think the due diligence piece is really kind of a hit or miss situation with most clients, and having to educate them of the implications of like not having up to date due diligence, and how that can impact their insurance coverage is really important. So we've been talking with a lot of our clients in terms of incorporating that into their risk management strategies and making sure they're at least doing environmental updates on a lot of their more hazardous sites.
Okay, so that education piece has been repeated by both Shane and Sean, Aaron, but is that level of awareness actually getting through to those stakeholders?
Yeah, I would say for sure it's getting it through, right? Like all various stakeholders involved in a property are certainly aware of the coverage and are getting more to ask for it. A couple of examples recently where a property manager was asked by one of their clients to have the coverage in place in order to have their business, and so this prompted them to insure their entire portfolio of properties that they were managing. And then another one recently too. This was more of a industrial risk, but a new board member joined the board and was surprised to find out they didn't have any environmental insurance for their business. So that again prompted them to go and place the coverage.
Is this state of the market just in compared to what we've seen over, say, the last decade?
Yeah, I would say in the real estate space, it's been a constant uptick. Every year, new purchasers always coming into the frame. I would say it comes down to the size and what the makeup of the company is in terms of experience. So those that I think, as Shane mentioned, Sean and Aaron, it's the education might take time to filter through all the various layers of people. So the more nimble the company, maybe the easier it is for them to see value, to understand how risk transfer would affect their bottom line, and what kind of losses they can sustain. So yeah, we've seen just a constant uptick. But real estate, industrial and commercial real estate clients were some of the first adopters, at least on the large scale, were some of the first adopters of environmental insurance. So now it's kind of filling in with the medium and smaller sized commercial and industrial clients.
Well, let's switch bases if we can to CPL, Contractors Pollution Liability Coverage. What trends are you seeing in that market in terms of the coverage that we're being able to get in Canada, particularly for civil contractors or demolition firms that are working near sensitive sites such as waterways or First Nations land? Sean, what are you seeing?
Yeah, Paul, I think generally speaking, there's been no significant changes on the contractor's pollution liability side. Obviously, projects that are closer to more, sensitive receptors are looked at a little bit more closely. But, we have tons of market support, lots of capacity. It's driving the pricing down. I'd say civil and demolition contractors are a little bit more high risk compared to maybe some of your traditional, GCs and whatnot. But I think the markets are typically very comfortable with providing coverage for these types of companies, generally because of like how technical the work is and also the reputation that they have in that space to do that type of work. So not seeing any changes. If capacity is on the lower end from a contractual standpoint, we can very easily fill it on an excess layer with another market. So no real concerns there right now from a placement standpoint.
Interesting to hear Sean talk about a level of comfort there, Aaron, but there has to be quite a lot of scrutiny around some of these projects as well, doesn't there?
Yeah, it really depends, Paul, on the project. In general, for civil projects, I'm not seeing a whole lot of questions or friction from underwriters. It's the nature of a soft market. It's really just people racing to the bottom for price and for getting the coverage there. But the one area where there is a little bit of scrutiny still would be cases where they're working with Indigenous communities, where there's questions about which laws would apply in that particular area. And then also, if the exposure happens to be remote, which means the cost to respond to a pollution issue would be amplified. There are questions surrounding that one here. But overall, again, getting contractor solution coverage in place is quite easy these days.
It's quite easy. Justin, do you agree with that?
Yeah, certainly. CPLs are very, we'll say, reasonably straightforward. I would say that I'm seeing an increased demand from larger contractors on the owners to make sure that coverage is in place. Where previously it was the owner driving the bus, now we're seeing a lot of larger contractors requesting that the owner have a program in place or compensate them for putting a program in place. Otherwise, CPLs have been a very, we'll say, profitable line of business, and therefore every insurer is willing to provide coverage, pretty broad coverage.
Every insurer willing to provide a pretty broad coverage. That means there's lots of availability then, Shane.
Correct. Yeah, capacity increasing, pricing dropping. You can't go wrong with that. I think obviously if you're a civil contractor building over a bridge or building a bridge, you're going to pay more than someone building inland, but that's to be expected. But at the end of the day, it's readily available product.
Zoom in on non-owned disposal sites if we can. Are insurers revising the language around the coverage for these sites, Aaron, especially given the recent enforcement actions that we've seen related to waste transport, illegal dumping in provinces like Alberta and Ontario? What are you seeing?
No, I haven't really experienced any changes to this coverage. Non-owned disposal sites coverage is still a throw-in coverage for the most part. There was a little bit of noise a couple of years ago with respect to the Ontario excess soils regulations. So some insurers had to adjust their wording or will adjust it on an as-needed basis when that exposure exists. But even the enforcement with respect to that has not been very strict as yet, not been a ton of loss examples yet for that. Overall, the frequency and severity of non-owned disposal sites losses remains quite low and remains more of a concern for clients who are working in the U.S. where there is more action in that regard.
Okay. Justin, are we seeing any coverage extensions at all?
We're not seeing any restriction in coverage on the non-owned disposal site perspective. Yeah, overall, that's been a very large coverage. It's been expanding to adjust to laws where it's supposed to, or where the law has changed or the regulations changed. But we're not seeing any real pullback in any way on that coverage. And I wouldn't expect any in the next couple of years either.
Okay, so coverage-wise, relatively few changes then, Shane?
Correct. Yeah, I mean, coverage remains the same. I'd echo that it expands based on the regulatory changes. There's been obviously more enforcement with regulatory changes. And however, just internally here, there's been several seven-figure claims coming through. And we've had some calls this week with more that will hit the books. So it's kind of, we'll see what that plays out in the market. Sometimes that can move the needle a little bit, or it's a soft market, so we'll see if that plays any part in it. But I don't have a crystal ball, but maybe Justin does.
I'm actually going to take it to Sean because, I'm looking into my own crystal ball and I'm seeing that everybody has agreed so far, Sean. So are you going to match that agreement, or are you going to throw a curveball at me?
That's 4 in a row right there, Paul. So, yeah, I would agree with everything Justin, Aaron, and Shane have said. I think from our end, with a new pollution prospect or buyer, depending on the markets that we work with and the way that the forms are written, sometimes there's some clarification required on what is a non-owned disposal site versus what is a non-owned location. But generally speaking, that coverage is readily available. And like Justin said, don't anticipate that changing in the near future.
You've all shown great perseverance while I bounced around numerous topics in the environmental risk space today. One final question to throw at all of you, if you don't mind, which is, in the past quarter, how have underwriters approached coverage for legacy pollution risks, particularly with aging infrastructure such as dry cleaners, fuel stations, bulk chemical storage? Justin, what are you seeing?
Yeah, I think the overall for an existing program, an existing portfolio of exposures, the insurers have been pretty stable. They underwrite each site, each exposure carefully based on the knowledge of the site, etc. Where I have seen a significant shift where the insurers are willing to take more risk is on a case-by-case transactional basis. So we are seeing off-site impacts now insurable for third-party claims. We are seeing the insurer taking on that risk of the third-party exposure where they know migration's already happened at the site. So without full quantification. So we are seeing, we'll say, an expansion in appetite. Maybe that's just a soft market with regards to land transfers that are contaminated.
Okay, so some changes to note. Shane, could we even go as far as to say there's broader risk transfer now than ever before?
Correct. Yeah. I mean, I would echo that. Third-party coverage is readily available for known contaminants on the site, and it's just a great time to be purchasing environmental insurance. It's a soft market. If you're not in it, get in it and take advantage of this wave of available coverages and low premiums. So that's all. I'll leave it at that kind of excitement. It's a fun time.
All right. Well, Shane has done the sales job for us, but Sean, I imagine we've got to really understand the clients more than ever as well, haven't we?
I think so. Like obviously, like those classes that you mentioned, Paul, they're considered high risk in the environmental market space. But again, like Justin alluded to, it is case by case specific. I think the markets, what they want to really see from the clients or the policyholders are, what their commitment is to managing the environmental aspect of the risk. There's a lot of market support. It really comes down to technical underwriting, creative underwriting. We did have a situation recently where we were placing coverage for 45-year-old underground storage tanks. And, very, very challenging because you think most markets would be very tempted to decline this risk right out of the gate. But we were able to, get a solution from a couple markets. And, I think that came with the client's commitment to also doing further sampling, which was a layer of comfort for the insurer. So, sometimes it's like a tag team effort. The insurer needs to do some things for the markets to come halfway, but generally speaking, coverage is readily available in these spaces. It's just, what information do you have on hand and how far are you willing to go to get that coverage?
Okay, so it's all on a case by case basis. And I imagine, Aaron, as well, that's the attitude being taken by the insurers.
Yeah, for sure. Each insurer really has their own style and appetite when it comes to how they handle known and suspected contamination issues. As the panel has agreed, differentiation really is in those who are willing to provide that third-party coverage for known issues, suspected issues, and then when there are exclusions that are in place, those who are creative in that they can geographically limit the exclusion to certain areas of the site or certain constituents, that sort of thing. Again, it all comes down to creativity, and as I think Shane's point was bang on there, it's a great time to buy the coverage. There is lots of capacity and a broader appetite than it might have been a few years back.
Once again, an excellent panel and fantastic to have this with us. For more superheroes like these, make sure you join us next time right here at Insurance Business TV.